Welcome back, everybody, to the second part in the multi-time frame analysis market structure video. This is the first section in my new series, Beginner to Winner, aiming to take you from basic trading understanding of my own concepts of strong money Forex to learn how to trade, how to take safe trades and ultimately make yourself some money in this market so you can pass prop firm challenges, grow your own account, or whatever it is that you want to do. In this second video, we're going to delve more into these market structure concepts. We're going to talk about how we use these in our trading, how we can use these to predict where the market is going to go. We'll touch on some more advanced concepts such as liquidity and how we can use this in our trades in order to get into safer trades. We'll also touch on one of my favorite hacks, if you want to call it that, which is protected highs and protected lows. These protected highs and protected lows allow us to place safe trades with safe stops, and we'll use the order flow of the market to determine where our safe entries are, where our safe stops are, so that the odds are in our favor and therefore we're more likely to win when we take our trades. So if you're enjoying this content, and if you'd like to hear more about this, please do me a huge favor. If you can like, subscribe, and switch that notification bell on, it helps me out massively with my channel. It only takes you a couple of seconds, and I really appreciate it. Thank you. Why does the market move like this? Okay, so I don't want to overload you guys with loads of really complicated information, but basically what happens within the market is there's what's called liquidity points. There's money sat beneath these points that the big institutions ultimately want to take out. Okay, they move the market in various directions. They target lows, they target highs, and they target other traders ultimately. So this is a good example. Okay, below here we have money sat there. What happens when people see the market go up like this? Okay, we see the market go like this. What happens? Ultimately, what happens is people place their stops here. They enter trades like this. Okay, they place their stops there below these lows, and they make some decent profit. Okay, but then this is now a target. You've got stops here. You've got money there. Okay, you've got stops there, loads and loads of stops all over here. This becomes a target. So what happens is in the higher time frame downtrend, which we're in here, these lows are targeted, and you can see they often get swept. So the market's moving to take these liquidity points. That's ultimately what's happening here. Okay, you have liquidity up here. Okay, you have liquidity below, down here, above here, below here, above here. Everywhere there's orders placed, whether it's stops, whether it's buy orders, whether it's sell orders, there's liquidity points, and they are targeted. Are targeted to be taken out and to be swept. And you can get a good idea of where the market is due to go based upon these things. Okay, if you know you've got, say, equal lows here, we know there's going to be stops there. You're going to have stops there. Okay, loads of stops there. You know you're going to have stops there. So where's price most likely to go? Is it most likely to push back up, or is it most likely to push back down? Okay, and take out these lows, because as soon as price comes down here, all of these stops get ran, these stops get taken out, and then all of those buyers, they're out of the market. Remember, it's a zero sums game. That means is for every buy position, there has to be a sell position. And if there's loads of buy positions in the marketplace, there's more buys than there are sells. What happens? There's more buys than sells, the market moves up. Equally, if there's more sells than buys, the market will move down. So in order for people to make money in the marketplace, you have to be in line with that. And the big institutions, so the big players, the banks, the whales, whatever you want to call them, the composite man, the institutions, the hedge funds, however you want to look at it, in order for them to make their money, they can't make their money when there's loads of buyers and sellers in the marketplace. So they will often target these liquidity points to take you out, free up the marketplace. And then this is often we'll talk about this in a later video, but this is often quite a common move that they do. They'll push the market down, they take out all the buyers that were down here. Then they push the market up and they take out all the sellers that were, say, here. Okay. And then what they do is once they've cleared the market either side, they then push the market past these lows, and they continue to take out buyers and sellers all the way down. But now they've taken out buyers, they've taken out sellers, and they've left the market free for them to push it down and make their money. Okay, and this is quite a common pattern. You'll see this pattern happen quite a lot. Okay, these moves where you'll see these moves all the time, where there's money sat in these places here, here. They push the market up, they push the market up, take out early sellers, they push the market down, okay, and they lure people in. So what's happening here? People are buying here, people are selling here, then they take those buyers out, and they take those sellers out. Now all of these people, they're out of the marketplace. That sell positions, they're being taken out here. These buy positions, they've been taken out here. These sell positions, they've been taken out here. So the market is clear for them to then push the market all the way down in their direction and take all of their money. So you've got to be careful. You've got to keep on the right side of them. So how do we know where the market is most likely to go? Short answer is we don't really. Okay, we don't know where the market is going to go. We can use certain patterns or understandings to kind of help us understand where the market's likely to go, but we don't actually know. We can just use probabilities and try and develop an edge. So, this market is clearly in a downtrend. So I know pretty relatively just through my own experience that if you sell from here, the price shouldn't go above this high. Equally, if you sold from here, price shouldn't go above this high. Okay. So you can use these things to kind of give you an indication, but you don't actually know where the market is likely to go. And it's through just experience and timing and understanding. If we're in a downtrend, the best option is to go for a sell, and if we're in an uptrend, the best option is to go for a buy. And if we're in a ranging market where we're not really moving, like in this section here, where we're not really moving kind of up or down, maybe you want to sit out. But we're just stacking. What we're going to do, I'm going to teach you how to stack confluences or um, stack probabilities in your favor to help you understand where the market is likely to go. And there's certain key kind of indicators that will tell us where we're likely to go, what's most likely to happen. But the long and short of it is we don't know, and you will never know. And even when you've got the best trades in front of you, the market will often do the opposite, and that's what is so hard about this. Now, one of the key things that I use in my trading quite a lot is what's called protected highs and lows, or safe highs and lows, however you want to look at it. Okay. Now, to me, what indicates a safe high is when we've created a new low. Okay. So let me just draw this out for you quickly. When price moved down and broke this structure here, okay, when price moved down and broke this structure here, we created what I call a safe high. Okay, this zone here is now a safe high because the market has had enough power to break these lows and take out these liquidity points. Okay, this now becomes protected, i.e., we're in a downtrend. We can clearly see we're in a downtrend because we've broken these lows and taken out these liquidity points. So price should not be able to come back up here, because if the big players are moving the market down, they do not want price to go above here. If they go above here, they lose money. Remember, they've sold here. They've sold the market. They put loads of money in the market. Think about how much money it takes for the market to push past these lows. It takes a lot of cash. Okay, so if the big players are selling, they don't want the market coming up here because they lose money. Okay, so ultimately that becomes protected. Okay, and we use these protected highs and we use these protected lows in order to keep us in safe trades. Another example is here. Look. Okay, so markets pushed high, push low, push high, push low, push high. So in order for price to push above these areas, okay, we've had to take loads and loads of money. Okay, which means we do not want price breaking below this low. Okay, we've taken out these liquidity points here. Okay, we don't want price, the big players don't want price to come down below here, because if we come down below here, they lose money. So this is now protected. So this is a pretty safe way to trade, and this is why we use structure. This is how important structure is. I know now, because market has moved up here, taken out this high and taken out this liquidity, I know that the market does not want to. It may do, but does not want to break this low. If it breaks this low, the big players lose money. So this is a relatively safe trade. And you could have taken this trade, like we showed earlier, you can take this trade and you've got a 2-to-1 and you'd have made some cash. Okay. So this is basically how we use market structure in our trading. What we're looking for liquidity points. We're looking for areas that we can trust. We're looking for protected highs. We're looking for protected lows. Okay. We're looking for these zones that we can trust. And we're looking for moves and various other factors that we'll talk about in later videos to help us understand where the market is likely to be headed. But the most important thing in your trading always is market structure. If you are in line with market structure, half the battle is won. Okay. If you are one of these people where you're trying to buy when we're in a clear high time frame downtrend, you might make a little bit of cash, but more often than not, you're going to be stopped out. Okay. What a lot of people try and do in this game is they try and constantly catch the reversal. They're constantly trying to catch the low or the high, or the low or the high. And it's a way of just losing cash all the time. I've learned the hard way. The amount of times I've taken, reversal trades like this, for example, and I've tried to catch, right, this is it, right? So, we've been in a downtrend for a little while now. Yeah, we're going to move up. We're going to move up. And you bet on the price market moving up. And sometimes you give a little bit of a win like this, and you make a little bit of money, but ultimately more often than not, you get swept. So knowing where the higher time frame structure is going and not trying to predict the market, one real important factor that we'll talk about in another video is reacting versus predicting. And this is so important in your trading, okay? I'd much rather react to the market breaking structure, returning to order, and selling from a high like this. I'd much rather take that trade all day long. And old me wouldn't used to do this. The way I used to trade, I would be trying to catch reversals all the time. But nowadays, I'd much rather take a lower risk, lower reward trade in line with market structure than constantly be trying to catch a reversal and be stopped out. And that's because now the way I trade is I will react to the market and what the market's telling me. What the market's told me here is we've broken this low, we've cleared liquidity. So if we come back up to this area, what's most likely to happen? Well, what's most likely to happen is we're going to move down further and probably break this low as well, which, as you can see, it does. We're probably going to take out this liquidity as well. So reacting to what the market is showing you rather than predicting what you think the market wants to do is the most profitable way to trade. And if you can be in line with this in the higher time frame, the medium time frame, and the lower time frame, half the battle in your trading is already run. So that's it for the first video in this series. That's market structure. We'll go into these concepts a little bit more in later videos. Hope you learned something from this video today. If you have learned something, or if you haven't and you just enjoyed the content today, like I said, please do me a huge favor. If you can click the like button and the subscribe button and tick the notification bell. I'll be trying to release a new video every kind of few days, maybe once a week or so, and there'll be, I think, 10 videos in this series taking you from the very basics to how to follow the strong money properly, how to enter the trades, how to exit the trades, how to ensure you always stay profitable. Then we'll set out a clear set of rules, trading rules to follow that you guys can use if you would like to start your own trading journey. And then with those rules that we're going to outline together, we will then do a prop challenge, do a prop verification, pass, and ultimately get our first payout. So again, thank you for joining. Switch that notification bell on.